Many times we get confused between risk capacity and risk attitude. It is very important to understand the difference between the two. Risk capacity is the ability to take risk. This can depend on the investor's financial circumstance and their goals. For example, an investor with a higher level of wealth and income means that their risk-taking capacity is higher. Risk attitude, though, is the willingness to take risk. This has more to do with the individual's psychology than with their financial circumstances. Some people think that volatility in their investments is too distressing to them and they keep such investments far away. Based on these two characteristics, we can categorize investors into different classes: conservative, moderate, and aggressive. Regardless of risk capacity, though, some financially well off people still prefer to only look at hopes of regular returns rather than look for good appreciation. Ideally, such investors stay away from financial markets. But even if they do venture into the markets, there are some sort of parameters which they can look at to ensure stability in the stocks that they select. In this video, let us look at some of those parameters. 1. Higher dividend payout. Stable firms are those which have a lower need for reinvestment in their working capital. This means that they have the ability to return a higher portion of the cash generated as dividends back to the shareholders. For example, Abhishek Mahimn Ltd has a dividend payout of 70%, meaning the company is only reinvesting 30% and rest is distributed back to the shareholders. 2. Equity beta. Beta is a measure of a stock's volatility with respect to the market, typically the index. If a company has a high beta of 2.5, that means with every 1 unit that the index moves, the stock moves 2.5 times. Stable firms usually have a beta in the range of 0.8 to 1.2. It's neither high nor low. And 3. No excess returns. Stable firms may not be able to generate excess returns. They report a return on equity which is just enough to cover their cost of equity. For example, in Abhishek Mahimn, the return of equity is 12%, which is again equal to the cost of equity. Some of these parameters are just some examples that investors could look at when looking for a stable firm. Risk-averse investors looking for regular returns may use some of these factors in their stock selection. If you hold any stocks for which you want our team to evaluate and give you an outlook on its past and future potential, just get in touch with us by sending us an email to info@vivekam.co.in, or you can get in touch through WhatsApp through the numbers below. Keep watching as we tackle more topics in the coming videos. Thank you.